Hello and welcome to Trading with Technical Indicators. My name is James Boyd. We welcome you here on this July 21st. We have Cameron May in the chat. We welcome him, and he's a fellow instructor, and you've probably attended one of his classes before. Quick heads up, hopefully you had a good weekend, and we're right back at it. Today we're going to call this class Indicators plus Strategy. You can know all about indicators all you want, but at the end of the day, it comes down to the tip of the spear, if you will. What strategy you're going to use to try to actually trade the ticker symbol with the indicator. Last week, we actually talked about using a collar strategy. We're going to follow through on that here today, and we're going to talk about some management of that from what we talked about and showed from last week. That should be helpful because a lot of people need practice on what they actually learned and kind of see how that works over time. We'll show that, good and bad. Now, also remember that Cameron and I, we do post educational content on X. Occasionally, we do post funny pictures. I'm pretty much solo at the house, and my dog Jax, he's my constant companion. Put him in the backyard, and I told him I need some alone time. Saturday, he didn't take it very well. So we do post some funny things as well. So join us on X as well, and good times. And honestly, that's how people connect. Okay, and also follow some of the other traders and investors, and they kind of share some ideas. They're not recommendations, but that's really how a lot of investors connect. Just real quick, with what we discuss is as we show our examples, the information is provided for general informational purposes only. Options carry a high level of risk and are not suitable for all investors. Also, when we talk about the Paper Money software application, that is provided for educational purposes only. Investing involves risk, including loss of principal. So having an understanding of how much money or capital is the investor willing to invest and risk is fundamental. It doesn't matter if you're advanced, intermediate, or beginner. We should all know what that number is, okay? Now, today what we're going to do is, last week, I want to kind of show something just real quick. So last week we showed, and I'll share with you this link. This link is the playlist for our class, okay? So if you said, hey, I like coming to this session, and is there a playlist of the previous episodes? Yes, right here. Now, last week we actually talked about collar management considerations and why. Now, we started to kind of see that the market, at least for a while, was kind of starting to flatten out a little bit after a decent push. And we also have earnings coming up. Many investors are kind of nervous around earnings, okay? So we talked about the strategy of a collar, and what I want to do is kind of follow through on that, okay? Now, before we actually go there, I want to take a look at where the markets are in general. We'll talk about prices, we'll talk about indexes and sectors. Now, just real quick, did anything catch your eye here today in terms of what was maybe moving? Any takers on that? Anything? Now, by the way, this could have been last night, okay? Anything kind of stand out to you? Well, if we kind of said anything that stood out to us, if we're talking about prices, silver had a good pop. Copper's been pushing. Posted about palladium last night. Excuse me, platinum. You can include palladium with that. Gold has even gotten a decent push here today. And the US dollar has sunk, okay, again, at the 30-period moving average, and it's just still underperforming. So the US dollar under pressure, and some investors are trading correlation. Look, we can know all about correlation. It doesn't mean we have a single trade on it, okay? One of the most fundamental things we know about correlation, if the US dollar is going down, commodities could be going up. That's one of the first things you learn about correlation. Now, when we take a look at, so the main takeaway is silver's had a decent push. Copper's had a push, okay? Keep an eye on those. And also the US dollar at a recent shorter term low. Not the low, but a short-term low. Now, if we look at, let's say, indexes, okay? Just briefly, let's look at the Dow Jones, the NASDAQ, the Russell, and the SPX. Now, first off, when you look at the trend column, okay? And if we look at the trend column, the numbers in the boxes and the color, if I said number 3, that just means the price is above a 30-period moving average, a simple period moving average, and above the 10-period moving average, exponential. So there's trend currently, and momentum. If you're in trend 3, many technicians, investors, they like that, okay? Now, that's not implying that it's going to be there next week or tomorrow. It's just showing right now we're in trend 3. Now, some investors, when it's trend 3, they might say, cancel the vacation. I don't want to go on vacation. That could be the most expensive vacation I ever take if I'm not really watching what's happening in the markets, okay? When that trend 3 is there, it is on, okay? There's trend and momentum, and you're going to see that here in the charts. Now, if we said which index has shown the relative strength, well, that's pretty simple, okay? I'm not even sure if we could debate that. You could try to, probably might not get very far. Now, when we look at this is really compared to the SPX, okay? And what you're now going to notice is the main standout, is really the NASDAQ. Okay, so if you said, James, I like to trade relative strength and I don't have any positions in the NASDAQ, you like relative strength, you just don't trade relative strength. There's a difference, okay? And so the NASDAQ, now if I said NASDAQ, we know that we're probably saying semiconductors as well, okay? The semiconductors also hit a brand new high here today. What we'll actually notice when we take a look at the 20-day high, the 55-day high, it's in the NASDAQ, and it's also, for example, coming in the S&P 500. Now, if we actually said, what is the broken record? What is the Groundhog's Day of all time? Well, new high, new high, new high, new high, new high. Now, some of you are saying, James, keep saying that. It's music to my ears. Let's see what these charts look like for just a moment. And there it is, okay? Now, if you take a look at this, we've had this Fibonacci up for a couple of weeks. And if you zoom in on this, we talked about the NASDAQ, how it was tippy-toeing all over the 161 extension. We had what, like 7 touches? And then we've just kind of pushed higher, okay? We've actually had a crossover here today. This is day number 1 of the crossover. Now, this is the million-dollar question. How do we know it's going to go higher? We don't know that. Every entry is a setup. Someone could have gotten here and said, well, how do we know it's going to go up? How do we know it's going to go up? How do we know it's going to go up? How do we know it's going to go up? How do we know it's going to go up? How do we know it's going to go up? When people ask me that question, it tells me they don't have position sizing. If they have it, they're not comfortable with the amount of risk they're taking. Because if they knew those two things, okay, they would stop asking that question. And I say that not to be mean, but we got to get past that, because we can have bombs away upward trends, never be in. I remember someone back in 2017 said, man, who couldn't make money in this market? And I said, oh, a lot of people, okay? If they're not comfortable with actually how much they're investing and the risk they're taking, they're not in. So you could have a market like 2017 where it pretty much went straight up and investors could be watching from the sidelines. So there's opportunities, but the investor has to be ready. Now, when we take a look at the SPX real quick before we talk about the callers, same thing, Groundhog's Day, right? Not a crossover yet. We're pinching on the moving averages. That is a close above the high of the low day. Boy, don't you love how that just kind of keeps grinding away. And those little green dots kind of showing us we had 1 day down. Remember we talked about 1, 2, 3? We said of the 1, 2, 3, which would you want? Well, we said before, if you only have 1 day down and then you get the green candle again, well, that's as strong as you can get, okay? And it only went down for a day. And we didn't even really go down below the middle of Thursday's candle. Some technicians say, hey, that's a shorter term support level right in the middle. So when you look at the NASDAQ, when you look at the S&P, still pretty strong movement. Now, Kevin and I talked about kind of the 7 opportunities in terms of trying to make your capital grow. You know, when we talk about the stock market for some investors might be that candidate of where they want to allocate their capital. How do we know they're getting in? Well, if you're hitting new highs, I mean, they're not selling, okay? They're not net selling. There's net gains. Someone is buying, all right? Now, what I want to do is I want to see just real quick if there's any questions. Now, what I want to do, and this is very important to me, okay? We could talk about different indicators. We could talk about different strategies, but as a listener, we need to practice together in a paper money account that's simulated trading, and kind of go through scenarios and demonstrations, whatever we want to call it. Now, what I'm going to do is I'm going to go to the IRA account for just a moment. And what I want to do is, as the market has gone up higher, so is the account. What a shocker. Now, if you had some bullish positions, that might be the case. Now, what I'm going to do is I'm going to scroll down to this section that we talked about from last week. Now, just a quick reminder to ourselves, what is the strategy? It's called a collar. Now, if you said, James, I only invest in stocks or ETFs, great, because that's what we could talk about, right? In these examples of Expedia, NEM, and Uber, they all have shares right there. So if you said, James, I do stocks or ETF, great, that's our discussion. Now, let's take it one step further. Well, we know that if we had shares of stock, and for example, you sell a call, that is not a very complex strategy. That is a covered call, okay? And it mainly goes back to that if you sell the 185 call, you're pretty much saying, well, you're saying that anyone can take my shares from now until expiration. When you say now, that's from the moment that you sell it until expiration. So if we looked and kind of saw that, where's the stock now in relationship to the strike? Now, I'll be honest here. I'm a picture person, okay? So let's kind of draw this up for just a second. And I hope that this can be beneficial. So where do we get in this example? 177.64. So let's kind of mark this, okay? We can do this fast. Now, if we look at, let's say, the upside, it was 185. Okay, 185. That's the short call. And the long put below in this example was at 170. Now, the only way that the 170 becomes more valuable over time, or at least right now at expiration, is price has to drop down and or the volatility has to go up. The answer is quite a bit or a lot. Well, if we said, well, where's the stock price now? It's at 186. So it's right here. So in blue, we're going to write 186. So what happens with the 170? What happens with the 170? This pretty much drops to a value of nothing because you've ran out of time and the stock is at 186. Remember, the 170 is the right to sell. The 185 is the obligation to sell. Okay? So if we have an obligation to sell at 185 and the stock is at 186, do you think someone might want the shares? Pretty high likelihood. How many days to expiration do we have? Answer, 4 days to expiration, okay? So when we get inside the 4 to 10 days to expiration, this becomes very likely that if our shares are assigned, that means that the paid money shares are sold to somebody else at 185. As you get closer and closer to expiration, it becomes more probable, okay? Now, I want to kind of look at the position for just a sec. So really, this trade was done 2 weeks ago in this class. And if you take a look at this, what you're now going to notice is I want to kind of take a look at kind of what was the maximum gain and then where are we now, okay? Now, if we're talking about kind of numbers, I like to use Excel. I apologize, okay? But we're going to use this kind of as a little sheet just real quick, okay? So what we're kind of wondering is, with 4 days remaining, should the investor consider staying in? Might the investor look to exit? What does the investor consider on doing? How much of the maximum gain do we have in this example? Well, let's take a look at where those shares are purchased. We said 177.64, okay? And I'm going to put that, let's go right there. And then the call was sold at 185, and I'll put this right here. And I'm going a little slower because I want this to sink in. I'm going to get you today. I admit it. I'm going to get you, okay? When I say I'm going to get you, that means it's going to go to the brain here today, and it's going to sink in, and we're going to love it. Now here it is, 242. That was the call premium, okay? So we got 242 for that. Okay, and what you're now going to notice is you paid the 170, and how much was that? It was 217. So the question now becomes was there a credit or was there debit? And the answer is, well, it was a whopping 25 cents. That means you could make from 177.64 up to 185, but you really got another quarter on top of that. Is everyone with us? Okay. So what we're now wondering is we got in the example, the paper trading, simulated account trading, 177.64 up to 185.25. Can't make any more than that because we obligate ourselves to share the shares at 185. So we want to know what's the difference from that number to this number. What's the difference? Well, it's 761. Now this is a per share value, per share. Now, if we had 100 shares, what would that gain be? Go ahead and type that in. So this 761, that's per share. That's from here to there. So if we said, well, we got 100 shares, it's just going to be that number times it by 100 because you got 100 shares. All right, now we want to ask ourselves the question, how much of that $761 do we have now? Well, it's a simple answer. Let's go back and say, where are we at now? Tell me how much do we have? Now, we're not looking at, well, on the stock I have this, on the call I have this, on the put I have this, et cetera, et cetera. We're looking at the net. Now, a lot of times when I would do this first, in practice, I would think, well, I don't want the call to be negative. I don't want the put to be negative. Yes, you do. Because if the call is negative and the put is negative, that means the stock has gone where? And the answer is the stock has gone to the upside. And that's what the investor wants. Why do they want that? Because they're the ones that own the shares. All right, so here it is, 586. So the question now becomes, this is the current P&L. This is the current P&L. And what you're now going to notice is this is the dollar amount, okay? And what you're going to see is, I want to kind of see what the percentage is, okay? Now remember, the dollar amount's important, but you really want to kind of see the percentage, okay? And the percentages of the maximum gain. So we're at 586 of the 761, okay? So if we said, how much do we have? Answer, we're at 77%. Now, that trade was like a 2-week trade. Where do we see that? When you click on the 586, it was done on 7/7, okay? Now, I'm going to tell you right now, let me ask you a question. Do you know any greedy people? I'm not going to ask their names. They could live near you. I'm not going to ask their names. I'm not going to ask where you live. Do you know anyone that's ever shown any signs of greediness? Ever? Now, that same person that says, I won't take 77%, is saying that their portfolio went up 5% for the year. It's kind of odd, okay? Now, remember when we talk about the 50% in the first 10 days, 65% if we have more than 20 days, we talk about 80% ever. With 20 days or so, we can't say that, okay? This is 80% ever, and currently we're sitting at 77%. Now, we cannot be so like, nope, my rule set says 80% or else I'm not getting out. Remember, you've run out of time now, okay? You like 80%, but you've run out of time. So if the investor says, James, this would have been the best case scenario, but it didn't happen. I only have 586 if we can get filled. And the investor says 80% ever, okay? We're at 77, I'm out of time. I'm not going to run it down all the way to expiration. So if the investor says, well, how do I get out of the position? Some investors, they like to just sell out individual positions, meaning we're going to right click on that call, buy it back, and now what you're going to see is we're going to buy back. Now, why an individual? Well, because they're trying to make sure they can buy back at the mid price. Notice the commission as well, send the order. Now, notice what I'm doing first. We're buying the obligation back, okay? Now, why don't we sell the shares first? Well, if you sell the shares first, that actually means that you have a short call and it's naked, meaning you do not have the shares to cover the obligation. Right click, create closing order, sell the put. Now, we could kind of sit here and argue with this and say, James, Could maybe the investor just try to let this expire worthless? We could. But the biggest thing that we're kind of a little concerned about, if that stock were to tank down to 170, that could become short the shares of the stock at 170. If we just want to get out and close that down to make sure that we do not have that position anymore, shut the put down. Now, that call is not filling yet. I want to come back and see what do we got. Let's do cancel replace order. I'm going to try to push up the price. It moved on us a little bit. Going to move it up a nickel. Now, I moved it up a nickel. Now, where's all the gains? All the gains are in the shares. Right-click on the shares, create closing order, sell. How many of you think that's probably pretty possible that you could just right-click on those and just try to sell at the mid-price? How many of you think that's pretty not too tough? Okay? Now, if we go back to where this was 2 weeks ago, what did this look like? If we looked at Expedia, where was it last week? And by the way, I'm going to do something here. This might shock you, but if you watch me for time, this wouldn't shock you, okay? Where was it on July 7th? Well, if we went back and say, where was July 7th is about right here. Now, what type of entry do you think we took on this? Was it a bounce trade? Was it a breakout trade? What would you call it? Well, I think we could probably say, James, it kind of looked like maybe the example trade was a breakout setup. But if we kind of went the day before, I think we could kind of argue and say, James, there's a green dot right there. That was a close above the high of the low day. That was a bounce after a one-day pullback, the strongest setup we could get in the shorter term. And then the very next day, you're going to see that was pushing into resistance. All right, so now let me just ask you a question here. So what about now? What about now? Have you ever been so proud of yourself that you just kind of said, you know, I feel pretty good about myself? And it's like, hello, the chart maybe is not done. No, I've done that. Oh my gosh, if I could talk to myself historically, you know, now if I zoom in just a little bit, let me help us all out here. If I zoom in here to the right-hand side, it kind of looks like we're getting a little starting to get a little pinch on the moving averages again. Now, if we're counting, kind of looking at the moving averages, we're seeing that the whole moving average, the 10-period moving average, went green. That's an indicator of short-term momentum coming back in. Now, the 20-period moving average is already green. What does that tell us? There's still a current trend. Now, number 3, moving average crossing over. The investor can wait to number 3. They need to see the price go up more to confirm that. Does the investor have to wait to 3? No. If the investor tries to get in 1, they're trying to get close to support. If they're trying to get in actually number 2, they're trying to still get closer to support, but actually a little bit more confirmation. Waiting for number 3, the crossover itself. Confirmation, remember, it's not free. It actually means that the stock is getting further and further off the support, and that's what I mean by it's not free. The investor is willing to pay a little bit more for the confirmation that it's bouncing. Now, this one is all yours. No, James, I like it when you do it. I can just sit here and listen. Well, it's over. Done. I'm going to kind of throw this out that you're considering in practicing in paper money, a collar trade. You tell me which ones and how to do it. Oh, I hate this. I hate this. When I was in college, I would hate this. I'd be like, I got to go to the bathroom. Let me come back when the teacher so they don't stare at me. I'm not sure what I'm doing. I wasn't really listening. I was looking at my phone. Whatever. How do we set up this trade again? Now, it's easy to kind of look backwards, but what about right now? So how do we set up the trade? Now, Wiley says, stock market genius. Wiley, we're not shocked. So, okay, so here it goes. Now, how do we do it? In the paper money simulated trading, we're going to click on the ask price. What is that going to do? It's just going to buy the shares of the stock. Now, how do you sell the call and buy the put? Well, what we're going to do is going to go down to advanced order, single order, and we're just going to change this first trigger sequential order. All this is saying, it's not even that complicated. is do the orders in a step, a process. The process I would like it to follow is, number one, buy the shares of stock. Step number two, it doesn't really matter. Do we buy the put first or sell the call? I don't think it matters. I'm going to come in here to the first trigger sequence, meaning do it in this order, okay? And I'm going to come back in and say, which call might the investor consider? Now, which call did we talk about strike-wise? Did we talk about selling last week in our examples? Which? Did we talk about selling the at the money calls? No. Did we talk about selling the way out of the money with a 5 delta call? No. We're trying to kind of focus on something that might have a delta between 30 to 40. So that's going to be like more of a balance between getting enough premium, which is why the investor's going to do it, but also have it somewhat of a little bit lower probability, okay? If we said, well, which strike has liquidity? Well, one of them is the 200, okay, or also known as the 200. That's a 20-cent bid-ask spread, and what you're now going to see is the 1250 on the open interest. Now, how do you sell it? Remember, this is one-click functionality, okay? I went into Burger King the other day, and you walk into Burger King or McDonald's, everything is one-click functionality. You want a Big Mac, you want a Whopper. This is the same idea, but you're using a mouse. If you want to sell it, click the bid. There it is. Now, by the way, now how do you buy the put? Well, remember we said on the put, same idea. We're trying to go to a delta 30-40. If I looked at which ones have a delta 30-40, so 175, that one, the 177.5, and the 180. Which of those really has a higher, okay, volume / open interest? I'll say open interest in this case. It's the 180. The one thing we made mention of last week is whatever the call premium is, we're trying to use that as enough money to buy the put. This one is a little higher. Now, you could do it. You just won't have a net credit. It'll be a debit. And what we're going to do is we're going to do the 175. Now, notice that the 175 has a ask of 605. This will be a slight debit, okay? And I'll show you what that means in just a moment. We're going to click on the 605. Now, why are we hammering this strategy for 2 weeks in a row here? Well, because we're looking for bullish trends, but at the same time, we're going to do 590 on that. Yep, 590 is the mid. So what I'm going to do is let's go back to our little sheet of paper we used. What was the stock price? 186, okay. Was it 64? Nope, 186.29, excuse me. Now the 180, what strike do we have? The 200 and the 175. Let's kind of draw this up a little bit. And if we kind of said, well, what was the premium for the call? Answer, 535 and 590, okay? 535 and 590. Now, remember we said that when you take a look at that, are we getting a net credit or actually is it a net debit? So we can make up from 186 to 200. But what you're now going to notice is we don't make up to 200 per se because, well, we're paying a net debit of 60 cents. This is the cap, okay? So really, if you include the caller piece, you really make up to 199.40 pre-commission. Now, how many of you think if you did this strategy over and over and over, just like this, you'd say, I'm starting to kind of pick it up? Well, that's the point, okay? Now, what I'm going to do in this is I'm going to come back and we're going to send, I'm going to do confirm and send. Now, I don't have a lot of hope right now that that's going to fill in that IRA. I'm going to do it in the margin, but I'll make sure I put it in the IRA, confirm and send. That should get it filled there, okay? Now, what I want to do is I want to just take a look at one more, okay? Now, I want to go back to just for a second, position. Now, by the way, this would be a nice little discussion here because now I'm going to go to the account. We have the margin account, okay? Like the market, the sample portfolio just kind of pushing up to a shorter term high as well. kind of trying to mimic what the market is doing. And one of the positions we have in there is NEM. Now, what is NEM? Are you surprised? Been watching precious metals lately, right? Well, if I pull this back up, a couple stocks, when people think of gold stocks, they usually think of maybe AEM perhaps, AEM, which we're going to hit, show the example. We're also, for example, going to bring up NEM, okay? Now, if you looked at NEM, they kind of both look a little bullish, but at the same time, if we kind of took a look at the NEM, it might be a little bit more bullish because we're kind of closer to resistance. Now, what I'm going to do is if I showed you AEM for just a moment, what does AEM look like? AEM, why did I make that comment? I'm just saying the NEM is a little bit closer to resistance. AM trailing by a little bit, but hey, if it goes up again tomorrow, it's going to be right where NEM is currently. Now, what I want to do to show last practice is let's kind of look at that position and just kind of run through the basic numbers. Now, when I look at this profit loss gain, okay, and actually before, by the way, I'm going to hold on to that. The one I want to actually hit just real quick is Hood. Now, don't worry, I'm going to come back to that, okay? The reason why when I look at NEM, we probably don't need to talk about that. It only has $94 upside gain. That's probably not going to be something we need to talk about managing. Remember, if you had a delta of 42, how much has the stock gone up, okay, to get an unrealized gain of $94? Pretty simple. $94 divided by the delta. The stock went up $2, okay? Now, our examples, we're going to come back to these gold ones in just a sec. The one that we probably need to discuss, though, is the Hood example, okay? And I apologize, I messed up on that, but don't worry, we're going to come back to the gold. Now, I'm going to type in the same numbers that we did before, kind of the same process. Purchase the shares at $99.18, okay? $99.18. What was the short call? And we can do this faster now. Short call was $5.05. Okay, $5.05. And what was the strike on that? It was the 110. Okay, here we come again. Okay, now what was the long put? It was the 90 for 410. 90 for 410. Okay, so now when we actually take a look at this, did we get a credit or debit? The answer is it was a slight credit. And we'll pull that up. And it was 95 cents. So we can make from 99.18 up to 110 plus the credit. So it's like making up to 110.95 pre-commission. Question now we've got to ask ourselves is, when you take a look at what's the gain overall, okay? And I'm just looking at this piece right there. What do we have? Okay. And actually, let me take this back. So from here to there, the most we could really make on that is $11.77. That's the difference between that and that. So if we had 100 shares of stock, which the paper money account does, it'd be $1,177. We need to now find out what is the current P&L. Answer, we have, if we look at that, it's $396, $398. So if we look at this and say, how much do we have so far? The answer is we're up 34% of the maximum gain. What does the investor do? Well, I mean, it's good so far. It's just not, the investor might be saying, James, I need a little bit more. Are we at expiration yet? No. Okay, so do we have, in the example, greater than 50%? No. Do we have 65%? No. First answer, first question negates the second, and then negates the third. Do you have 80? Okay, we don't even have 50%. Are we running out of time? Are we inside 4 to 10 days of expiration? No. So on this one on Hood, there's nothing to really do here, and it's still grinding away to the upside. Hood does not really have resistance. It's kind of more just kind of grinding to the upside in a kind of a slower upward trend. I say slower, but that's not really true when you look at percentages. So Hood, there's nothing to really do there besides let it grind to the upside. Now remember what I said before. Does the investor want the short call and the long put to lose money? The answer is yes, Because if those are actually losing money, that typically means the stock has gone up and the net is positive. Okay. Now, what I'm going to do in this case, so the question also comes in, well, taking a look at break even, right? So this is the initial cost. Okay. So let's assume that this trade is held all the way to expiration. Well, if this is the credit and we let everything expire, everything expires worthless, what is the break even at expiration? Assuming they expire worthless, and the answer is the new break even, assuming that the call and put expire worthless, it's going to be 98.23 free commission, assuming the call and the put expire worthless. That's all it is. If it was a debit, it's going to add theoretically to that cost basis. That's all it is. All right, now let's go back to gold for just a sec. Okay. Now let's say the investor said, James, we have an example on Newmont Mining. We have that. And I want to go back to the kind of the question that happens a lot of times is, well, okay, fine, I have a caller, but I'm now a little concerned that NEM could be breaking out to the upside. So which side of the trade is the investor more concerned about? Are they concerned about the put piece? That's the right to sell. I mean, are you concerned about that? Not really. The most the investor could lose is $1.29 on that put, right? I'm not concerned about that. Is the investor concerned about the call? Yeah, I'm concerned about that. How are you concerned? Well, I'm concerned because if the stock goes above that strike, it's capping my upside gain. Now, you might say, I'll take that capped upside gain because that could be quite a bit of money, okay? So, I mean, yeah, maybe. But if the investor said, where am I really concerned? It's the stock position. Because if the stock actually goes down, that's the position that actually has, or the strategy that has the highest delta, okay? Now, I'm going to kind of do this. So what happens here if we have earnings coming up? What happens? Now, last week we talked about, hey, wonder if the stock breaks resistance, and it breaks resistance by 1 to 2%. Remember us having that discussion? Now, the question now really gets asked is, well, maybe is that a logical step to buy the call back prior to earnings? And I'm talking about 2 to 3 days prior to earnings, 2 to 3 days after earnings. Is that a logical thing to do, to buy the call back? How do you know the stock's not going to gap up and then slam back down? And the answer is, many investors might say, James, I'm going to keep the call on because they're trying to get through the earnings, okay? So in this example, we're not going to touch NEM, the caller, okay? We're going to keep the short call on and going to try to get through the earnings. And listen to what I said. 2 to 3 days before earnings, going to keep the collar intact. 2 to 3 days after earnings, we want to reassess and say, is that stock above support? Stop, okay? And if it still is, and then it starts to break out, that's when the investor could reevaluate and say, I'm going to buy the call back. We got through the earnings. The stock is still above support, and now it's starting to break out to the upside. I'm going to try to buy that call back if I can. Now, in the meantime, what might the investor consider? Trade example number 2. So we did the Expedia trade, we reapplied the collar, but let's say the investor said, James, right before earnings, the volatility tends to be a little high. Sometimes what investors do is they come in and say, look, I'm going to sell those pets, okay? And they might want to say, I'm going to try to use the higher implied volatility and see if we can't sell something. Now, does that mean everyone should do it? No, absolutely not, okay? Now, what I'm going to show is the implied volatility annualized is at 43%, okay? 43%. The higher that number, the higher the premiums tend to be. So when you look at the premium, you're looking at the option premium, $1.20, and you're saying, well, how much is that compared to the stock price? Well, the stock price is $60.42. So the 120 is the option price, and the $60.42 is the stock price. And I like to call that the option yield. It's like dividend yield, okay, in a way, similar, okay, not the same, but it's going to give us the option yield. Now, if I kind of said, hey, $1.20, divide that into, let's say, 60/40. Well, it's really right about 2% if we round it up, okay? So if we take a look at this, some investors might say, James, now you got to remember, this is with 25 days remaining. The investor might say, James, I don't want to go 25 days, okay? Matter of fact, I have too many positions that are 25 days. I might want to go a little bit farther out, okay? Now that might be a fine comment provided that there's liquidity. Now what I'm going to do on this is we're going to go to a little bit, we're going to show the example of selling the 57.5 for September. Now I double check liquidity, right? You look at this, open interest, 4,500, 2,500, 1,400, 25. We're going to go to the 57.5 and we're going to sell the put. Now, when you sell the put in an IRA, well, the risk is all the way down to zero. Or what the investor could do is say, I'm going to do a sell vertical. This is not the typical vertical that we're thinking about. It's really, we're going to sell it at 57.5. And then what we're going to do is we're going to buy the 47.5 or even the 45. Now, just like you would with a vertical, right? If you sell the 57.5, you buy the 45, spread width is $12.50. That's not new. But less the credit, $1.91, it's going to give us a bigger maximum loss, noted, but it's also going to reduce the buying power, which is the maximum loss, and you're going to see that right here. So some investors don't like selling puts without downside protection. What is the protection? The protection is if this stock completely falls apart and drops down below 45, at expiration, the investor has the right to sell the shares at 45. Okay, not theoretically, this is not a stop. Okay, they have the right to sell the shares at 45. This is very key. Okay, it's a different, I mean, you could read it in a book, but until you practice trade it, doesn't really sink in. So trade example number 2 is doing this is really a cash secured put. But in the trade, it's showing like a vertical just because we're accompanying the short put with the long put that's out of the money, that's not very expensive, and it doesn't have a high probability of success, but we just want there to just create a max loss that's not all the way down to zero, and also reducing how much money is being set aside, okay, to do the trade. Now, so here it's trying to benefit from direction, time, and volatility. If we sell the put, where do you want the volatility to go? Do you want volatility to go up, or do you want volatility to go down? The answer is you want volatility to go down. So if we kind of said, what indicators do we see really on this chart? We'll kind of see a classic, like 1 touch on the bottom, 2 touch on the bottom, 3 touch on the bottom, 4 touch on the bottom. Is that kind of creating a higher base of support? Many technicians might look at that and say, it kind of looks like it is. Now I'm going to go back in 1 minute. We're also going to kind of show the example of AM with the same idea. Now, are those trades correlated? If you were trading AM and NEM, would you be watching milk prices, cocoa prices, sugar prices, lean hogs? Is that what you're watching? Of course not. You're watching what the company is actually selling, okay? Gold, copper, whatever, right? Now, so when you wake up in the morning or at night, you're probably saying, hey, where are those prices at? Okay. Now, what I'm going to do is I'm going to go to the trade tab. In the last minute, I'm going to go say, okay, on NEM, if I actually looked at that and said, okay, let's bring that back up, AEM, 1 minute or less, we'll do this. Now, in this example, what I'm going to show is we're going to show an example of selling, and I'm going to go to September. We're going to sell a put that's closer to in the money. If the investor does that, what are they really doing? They're trying to be more aggressive. They're saying, look, I think, now they could be completely wrong. I think the stock could go up from here. Now they could be wrong and they could be the buy of the shares at 120. Notice that we're selling the 120, the 40 delta, higher in the range, and then buying the put below. So trade example number one we did was Expedia. Trade example number two we did was NEM, and the third trade example we did is AEM. I want you to keep an eye on those precious metals. Keep an eye on that US dollar. And also, I want you to keep continuing to practice and paper money count with the caller example. I think each week as we walk through earnings and practice these over a couple of weeks, you start to become more confident and kind of aware of how to manage the position. So I'm out of my time here today. Cameron May will be coming up next as he'll talk about covered calls and cash secured puts. Now, also remember with what we discussed, it was done for example, illustrative purposes only. Always remember that you could actually check out our playlist. This class has been recorded. You can also subscribe to the Trader Talks channel, okay, and subscribe. It's free. And also, if you said, James, how would I follow you right on X? Some of those updates you do throughout the day and throughout the week, there's my handle as well. So remember, with what we discussed today, it's done for example, illustrative purposes only in a paper money account. Also remember that all investing involves risk, and this has been Trading with Technical Indicators. And stay tuned for Cameron May coming up next. Take care. Bye-bye.